Welcome to the Deep Dive. Today we're taking a close look at PNC Financial Services Group, specifically their second quarter 2025 earnings.
Right.
Think of it like getting a quick, sharp assessment of a major financial player. We'll check the engine, the strategy, where they're headed, basically give you the essential insights fast.
Exactly. And this isn't just about, reading off numbers from a page. That can be pretty dense.
Yeah.
It's more about understanding the why. What are the strategies? What's the economic climate they're dealing with? And, what really makes a bank like PNC resilient and forward-looking?
Okay.
We'll look at the big wins, where the growth is really coming from, and maybe even some surprising stuff, like how they're thinking about AI or stable coins.
Interesting. And just to give you the headline up front, PNC had a very strong second quarter. Seems like it was marked by really focused growth and, frankly, disciplined management, even with all the economic uncertainty out there.
Definitely a solid performance.
So let's unpack this a bit. For the specifics, net income was $1.6 billion. That works out to $3.85 per diluted share.
Pretty healthy numbers.
Yeah. And what really jumps out, for me anyway, is revenue was up 4%, while their non-interest expenses were basically stable. Held the line.
And that right there is key. That combination leads directly to 4% positive operating leverage, plus a 10% jump in pre-tax, pre-provision earnings, or PPNR.
Which is that core profitability measure, right? Before setting aside money for potential loan losses.
Exactly. And how they got that positive operating leverage is, I think, fascinating. Growing revenue while keeping expenses flat.
Yeah.
That just signals real discipline, efficiency in their operations. They're clearly getting more bang for their buck.
Makes sense. The CEO, Bill Demchak, he put it pretty plainly, said it was a very strong second quarter fueled by our continued focus on driving growth.
Yeah.
And he specifically called out accelerating new customer acquisition and, deepening those existing relationships.
Which sounds great, but it does make you wonder, what does accelerating new customer acquisition actually look like for a bank this size?
Right, like on the ground, beyond the statement.
Yeah, exactly. Is it just spending more on ads, or is there something more strategic happening?
Good question. You should definitely dig into that because it says a lot about where you're headed.
For sure.
And also on the capital front, good news there, PNC kept its minimum stress capital buffer at 2.5%, which is great. But even better, their start-to-trough capital depletion was just 80 basis points. That's 0.8%.
Wow.
Basically how much capital they'd lose in a really bad downturn. And that was the lowest figure in their whole peer group.
And that's not just, a nice regulatory checkmark. It's a real strategic edge.
How so?
Well, think about it. If there's a downturn, other banks might be scrambling, right? Pulling back lending, trying to raise capital.
Okay.
PNC, with that kind of resilience, could actually lean in, maybe pick up assets cheaply, gain market share while others are stuck. It shows real strength, not just ticking boxes.
That makes sense. A position of strength. And sort of proving that point, the board also boosted the dividend, up $0.10 or 6% to $1.70 per share.
A tangible sign of confidence.
Absolutely. But okay, how are they actually generating this value? Let's get into the core of the bank loans and deposits.
Right, the engine room.
So the engine definitely seems to be firing. Overall loan growth, up 2%. And commercial loan growth was particularly strong. They said it was fueled by the highest production levels they've seen in 10 quarters.
Yeah, and if you drill down into that, the commercial and industrial portfolio, C&I, that was up a pretty robust 4%.
Yeah.
The CFO, Rob Riley, he said it was a mix of things. Partly higher utilization, maybe companies drawing more on their credit lines. And he mentioned, interestingly, tariff-related considerations, maybe building inventory.
Right. Trade policy impacts.
But crucially, he also stressed strong new production, especially from their designated growth markets.
So that tariff thing, does that mean this growth spurt is temporary? What's the outlook?
Well, they did acknowledge that maybe that exact pace won't repeat across the board. Makes sense.
Yeah.
But they still raised their full-year guidance for average loans.
Yeah.
Went from just stable to up approximately 1%. So still positive.
Okay, so still expecting growth, just maybe not that fast.
Exactly. And it highlights that important difference, right? Some growth, like inventory buildup from tariffs, might be a bit reactive, maybe temporary. But the other part, the new production from our growth markets, that sounds like the result of deliberate long-term strategy.
For sustainable organic growth.
Precisely. That's the kind of growth you really want to see for long-term health.
Okay, let's flip to the other side of the balance sheet, deposits. Average deposit balances actually increased by $2 billion.
Interesting. Where did that come from?
Mostly from CDs, certificates of deposit, both the ones they get through brokers and ones they sell directly. Meanwhile, consumer and commercial deposits were pretty stable. Oh, and non-interest-bearing balances, the money just sitting in checking accounts, they ticked up by $1 billion. Still about 22% of total deposits.
And there's a deliberate strategy there, too. They mentioned exploring being sort of purposefully more competitive in new markets.
To gain share faster.
Yeah, especially targeting those DDA households, the everyday checking accounts. It's all part of their national expansion plan. A smart long-term move to lock in that core funding.
Makes sense. Okay, so loans are growing, deposits are managed strategically. How does this translate into income and managing costs? Let's look at revenue and expenses.
Yeah, the income statement side.
So net interest income, NII, was up 2%. And the net interest margin, the NIM, it actually expanded slightly by 2 basis points to 2.80%.
Right, and that 2.80% AM, think of that as the bank's core profit engine, right? The spread between loan earnings and deposit costs.
Got it.
And they're still apparently tracking towards a NIM around $2.90 by the end of the year. That's pretty strong.
What does that indicate?
It suggests they're well-positioned with asset repricing, basically, their loans adjusting to higher rates faster than their deposit costs are rising. And also smart use of financial tools like swaps to manage interest rate risk.
So a well-tuned engine, like you said.
Exactly. And they expect that positive momentum to carry into 2026 as well.
Good to hear. What about fee income?
Also solid. Up 3% overall.
Driven by what?
Strong performance in card and cash management. That was up 7%. Probably higher consumer spending, maybe some seasonal effects, plus treasury management activity.
Okay.
And capital markets and advisory also chipped in, adding about $15 million.
So revenue streams looking healthy. Now, the other side, expenses. How do you keep those flat while you're investing in growth initiatives?
That's the million-dollar question, isn't it? Or maybe the $350 million question here.
Right.
They credit disciplined expense management, naturally, and also what they call a continuous improvement program. That's where the $350 million target comes from for cost cuts this year.
So efficiency savings are basically funding the new investments.
That seems to be the idea. And their comments on AI were pretty interesting in this context.
Oh, yeah. What do they say?
Well, they're clearly using it. Fraud detection, sorting documents, building data lakes. The usual suspects. But they specifically said they don't expect a gigantic change in their cost base just because of AI.
That's a bit counterintuitive, maybe. You hear so much hype about AI slashing costs.
Right. But their take seems more pragmatic. It's like AI isn't some magic bullet. It's just the next step in their ongoing automation efforts.
Okay.
It helps keep personnel costs down while they invest in the tech itself. The really interesting long-term question for them, they suggested, is how AI changes, the actual delivery of services, like computer-generated financial advice.
That makes sense. More about service transformation than just immediate cost savings.
Exactly.
All right, let's shift gears again. Talk about balance sheet strength, specifically credit quality. Always important.
Absolutely crucial. And the headline there is, still looks strong overall.
Good. Any specifics?
Yep. Non-performing loans. Loans where payments are significantly behind, they actually decreased, down 8%, or about $184 million, to $2.1 billion total.
Okay, positive trend.
Yeah, and total delinquencies were also down 9%, about $128 million. And net charge-offs loans they actually had to write off as losses were $198 million, which was down slightly by $7 million.
So all moving in the right direction.
Seems so.
And what about their cushion? The allowance for credit losses.
That totaled $5.3 billion, which works out to 1.62% of their total loans.
Is that considered adequate?
Seems to be. And while the overall picture is good, they were upfront about expecting some charge-offs coming down the pipe, specifically in commercial real estate office loans.
The troubled CRE office sector. No surprise there.
Right. But the key thing they stressed is that these expected losses are fully reserved. Meaning they've already set aside the money in their allowance to cover those specific anticipated losses. So while the charge-offs will happen, they shouldn't hit future earnings unexpectedly. It's proactive risk management.
Got it. Managing expectations and the balance sheet. Okay, back to capital for a moment. They returned about $1 billion to shareholders this quarter.
Yep. About $640 million in dividends and $335 million through share buybacks.
Standard practice for a healthy bank.
Right. But it brought up an interesting point during the discussion about capital rules.
Oh.
Yeah, this sort of tension between the official regulatory capital requirements and what the credit rating agencies want to see.
Two different sets of expectations.
Exactly. And the point made was that right now, for the industry, the rating agency views are often the binding constraint. They're effectively pushing banks to hold more capital than the regulatory minimums might strictly require.
Interesting. So the rating agencies have become the tougher graders, in effect.
Kind of. It's this complex dynamic. Banks are navigating, satisfying regulators and the agencies to maintain those crucial credit ratings.
Okay, makes sense. So looking ahead now, what's the strategic outlook? Where's PNC focusing its energy for the future?
Well, a big piece is definitely executing that national growth strategy, especially on the retail banking side. They keep coming back to that.
Right, the expansion efforts. How's that going?
Seems like they're really pushing the accelerator. Consumer checking accounts grew 2% year over year overall.
Okay.
But get this, in the Southwest region, growth was 6%. That's pretty significant.
Wow. Yeah. Shows the expansion markets are gaining traction.
Definitely. And it's not just talk. They mentioned they're on track with that $1.5 billion investment plan to open over 200 new branches, mostly in those expansion areas. They're putting serious resources behind it.
So building out the physical footprint still matters, even in a digital age.
Apparently so, for their strategy. And this ties into the whole discussion around scale.
Meaning?
Well, some analysts were asking about big M&A deals, large bank mergers.
Right, the consolidation trend.
But the CEO seemed to push back on that idea for PNC right now. He emphasized that organic growth in these new markets is their main focus.
Building it themselves, not buying it.
Pretty much. Aiming to become a market leader wherever they operate. And that means heavy investment not just in branches, but also in new online banking platforms, mobile apps, AI-driven client services.
Yeah.
The whole tech package.
So it sounds like a strategic bet.
Yeah.
Instead of a big, potentially complicated merger, they're doubling down on organic growth plus technology.
Yeah, to win what they call the race on retail deposits. It's a clear choice about how they want to compete and grow long term.
Interesting. What about their view on the wider economy?
Pretty measured, I'd say. They expect economic growth to continue in the second half of 2025. Their forecast is for real GDP growth around 1.5% for the full year.
And unemployment.
They see it ticking up gradually, maybe hitting around 4.5% over the next 12 months.
And the Fed. The big question on rates.
Their base case seems to be just one rate cut from the Fed this year, a 25 basis point cut, likely in December.
Okay, so not expecting aggressive easing anytime soon.
Doesn't sound like it. But maybe the most forward-looking part of the discussion was around crypto and stablecoins.
Oh, really? What's PNC's stance there? Are they steering clear?
Quite the opposite, actually. They said they're actively engaging with crypto companies.
Wow.
Enabling clients to use crypto, and they expect to be part of whatever industry-led stablecoin solution emerges. They're not sitting on the sidelines.
That's pretty progressive for a large traditional bank. Are they worried about stablecoins pulling deposits out of the banking system? That's a common concern.
They addressed that directly, said they don't really see stablecoins draining deposits from the system.
How do they view them then?
More like just another tool in the payment toolbox, similar to how we use wire transfers or ACH payments today, just a different rail for moving value.
A pragmatic view then. Not an existential threat, just another payment option.
Seems to be their take, and it connects to potential revenue opportunities.
How so?
Well, they see chances to grow their payment and treasury management businesses by incorporating blockchain technology, offering new, efficient services to clients who want or need to operate in that space.
So embracing the tech to enhance existing business lines.
Exactly. And speaking of local impact, one final interesting tidbit they mentioned.
Yeah.
This huge $92 billion investment that was announced back in Pennsylvania focused on energy and data infrastructure, largely to support the build-out needed for AI.
Right. Massive data centers need massive power.
Precisely. And PNC noted how this is making the local economy there bustling. Available building sites are apparently disappearing fast.
And how does that ripple back to PNC specifically?
Well, think about it. A booming local economy means more demand for commercial real estate development, more C&I loans for businesses expanding to support that infrastructure build.
More jobs, more consumer deposits.
Exactly. It creates this really positive feedback loop. PNC, being a major player in Pennsylvania, benefits directly from that regional growth, which they're also helping to finance. It connects their national strategy right back to their local roots.
A powerful connection. Okay, so wrapping things up, it feels like you now have a really solid picture of PNC's second quarter and where they're pointing the ship.
Yeah, from the strong numbers and the disciplined cost control.
Right, through to the strategic moves in new markets, the branch builds, the tech investments.
And how they're navigating the economy, managing credit risk proactively, and even thinking about things like stablecoins.
It really paints a picture of a company focused on consistent, disciplined growth. Definitely playing the long game.
Absolutely. Very methodical.
So as we leave you to think about all this, here's a final thought. We heard PNC talk about investing in branches and digital and AI.
Right. Covering all bases.
If those digital tools and AI keep getting better, transforming how we get financial advice, how we do our banking, making convenience basically universal, what does that ultimately mean for the role of the traditional branch? And how will banks like PNC really differentiate themselves when just being convenient isn't special anymore?
That's the big question, isn't it? Something to definitely mull over as the landscape keeps evolving.